Warren Buffett talks about no strike. It's investing is a no strike call game. You can stand there for 1,000 pitches with your bat on your shoulder and you wouldn't get a walk or a strikeout. Of course, there's opportunity cost that's lost, but
all right. Welcome, everybody, to the Big Picture Blueprint. We've got a great episode for you today. A guy that's been in the business for a long time. I actually had read one of his books when I first got into the business, 2017, 2018. So it was cool to talk to him today. But before we get into that, what's going on back in Colorado, Mason?
Same old land deals and, working as a realtor now in addition to it too. So things are good. And I think it was refreshing to have a conversation with someone that has a lot of the same perspectives that you and I do on investing decisions, which is really, really playing for the long term and not just focused on the short, immediate and highest and best return, which is what you hear so often on podcasts. So today we had the pleasure of interviewing Paul Moore, and Paul's journey to success is anything but ordinary. After starting his career at Ford Motor Company, Paul co-founded a staffing firm and became a 2-time finalist for Michigan Entrepreneur of the Year. After selling the company to a publicly traded firm, Paul discovered his passion for real estate. Over the years, he has founded multiple investment and development companies, appeared on HGTV, and successfully completed over 100 commercial and residential real estate investments and exits. Today, Paul serves as the founder of Wellings Capital, a real estate private equity firm committed to helping investors achieve consistent, above-market returns. Wellings Capital raises money and awareness to combat human trafficking and rescue its victims, aligning business success with a higher purpose. And so, without further ado, let's bring Paul in. Mr. Paul Moore, it's great to have you on the show. How are you doing today?
hey, great to be here, Mason. Good to see you, Dan. Thanks. Glad to be here.
Yeah, we're excited to have you on the show. I know you've been on podcasts, had your own podcast and been interviewed tons of times. But for our audience who hasn't gotten the chance to listen to you yet, could you give us a 60-minute elevator pitch about who you are and where you're at today?
Yeah. I got an engineering degree back in the 80s. That was my first mistake. Then I got an MBA, went to Ford Motor Company, had my own company for 5 years. Very providentially was able to sell that to a small public firm in 97. Started a nonprofit in the Blue Ridge Mountains of Virginia. Got bored really quickly. I was a high energy entrepreneur in my mid 30s. And so started flipping houses, ended up flipping probably 60 homes in the Roanoke, Virginia area, and then 40 or so waterfront lots at a beautiful lake in Virginia called Smith Mountain Lake. In 2011, ventured into the commercial real estate space, eventually became a multifamily syndicator, wrote a humbly titled book on that topic, and then we, in 2018 and 19, pivoted over to being a fund manager. We now have, we're about to launch our 8th fund. We invest in self-storage, mobile home parks, RV parks, multifamily, industrial, and retail. So that's where we're at.
Wow. Okay. Quite the background. I love talking to people that have been in business for longer than I've been alive. And you alluded to something that I wanted to bring up. So I am familiar with you because I read your book, I think almost 8 years ago now, 7 or 8 years ago, The Perfect Investment. And before we started recording, you mentioned that was before you knew some of what you knew now. So can you expand on that?
Yeah, so I called multifamily investing the perfect investment, based on the income and predictable income, cash flows, appreciation, tax benefits, just the wealth building potential. But, after trying to be a multifamily syndicator for about 4 years, just realized that, the perfect investment is not perfect if you have to overpay, and if you have to over leverage, and if you have to assume extremely aggressive underwriting, and if you have to if interest rates have to stay at 5,000-year lows, and if you have to believe that trees will grow to the sky, and I'm talking about rent growth, just because it's grown for 9.5% in Tucson the last 7 years, Doesn't mean it will continue to. In fact, it's a good reason to believe it won't continue. And so we got really nervous. I was in my mid 50s and I thought, I don't want to make the mistakes I did before. My wife's tired of this entrepreneurial roller coaster of boom and bust. And so we pulled back and said, you know what? We don't want to play in this game anymore, at least not right now during this boom. And we found out the perfect investment was not perfect at all.
Okay. And what year is that approximately?
That was about 2018. We retooled the company in 2018. And we launched our first 2 funds in 2019.
Okay, so with these funds, what are the major differences? Because I know you mentioned a number of other commercial assets you invest in, but you did also mention multifamily. So is it the structure of these funds? Is it that you're more diversified amongst different asset classes within commercial real estate? What's the major change?
Yeah, I would ask the audience to consider picturing a curve that starts in the bottom left corner and then it goes up and to the right, like it's like an ascending curve, and it's that's the 80-20 curve, which means basically, of course, we all know the Pareto principle. The top 20% of the operators and deals get the top 80% of the results and all that stuff. Well, if you go up that curve, if you can pick the very best, let's say the top 5 or 10% of the operators and the top 5 or 10% of the deals, your results will be far, not a little, but far, far safer than the 50th percentile and far, far more profitable, because the very top ones, they capture a huge inordinate percentage of the best results. And so our theory was, look, we really think as investors ourselves, and the investors we know want diversification. We're not going to be able to be a top 10% player in multifamily alone, but far less, in self-storage, mobile home parks, RV parks. That would be stupid diversification, as Warren Buffett calls it. And so we knew we couldn't do that, but we thought we could go hand pick those, and we could especially find the ones that are really good operators, but not great capital raisers that need investments, and we could invest in their deals. And our theory was that if we could find the top, operators in the top 10% across all these different asset classes, our risk of losing money in a downturn would go way down, and our chance of making a nice profit for our investors would be greatly enhanced. And so far, that's generally worked. Our first year or 2 out of the box, we made a few mediocre investments, but since then we've done quite well.
I really like the strategy, and I think we'll dive more into it, but I do want to talk a little bit about just the nature of humans and how you had the podcast, how to lose money. And something that I've seen within myself and within so many investors is that for whatever reason, we just need to make the mistakes ourselves. And I feel like ideally, it's potentially easier to avoid failure than it is to copy success.
Exactly.
But
I said that on the podcast all the time.
Exactly. Yeah. And that right there is where I got it from. But how do you do that? How do you force the young entrepreneur, Paul, whenever you were in your 30s and all over the place and excited and eccentric and really ready and willing to go lose money and make mistakes? How do you actually get that into people's heads? And how do you operate your business differently to where you're not losing money anymore?
I don't have a great answer, so let me muse on it for a minute, and maybe we'll come up with one together. Warren Buffett and Bill Gates said that the smartest investor on the planet was the late Charlie Munger. Charlie Munger, the smartest investor on the planet, it might be smart to imitate him. And it's amazing to find out what his strategy was. So he's the smartest guy. You'd think he'd be developing the most complex, amazing algorithms. He would be coming up with these brilliant strategies, using 2.5, standard deviation from the mean and all this stuff. He didn't do any of that, and of course his friend Warren Buffett doesn't even know how to use Excel, from what I understand. He does everything in his head. But the smartest investor on the planet, he was obsessed with one thing, and that was not making mistakes. In fact, not repeating other people's repeatable mistakes, as he said it. So it might be nice to figure out what he did. Well, what he did was he sat in an armchair and he made very few investments and divestments. He sat in an armchair and read about 500 books a year. He read books on philosophy and science and physics and history, and he was pretty obsessed with people like Ben Franklin. And he just studied their principles, but he also studied mistakes and failure. And he just determined, to not do that. But he was also very willing to admit his own failures. He stood up in front of 40,000 Berkshire Hathaway devotees, and he said, "We were horses' asses. We failed you." And he was very open about that. He didn't try to hide it. Reminds me of Chris Davis from Davis Advisors, a real smart a successful advisory firm. They actually have a wall of shame in their office where they put the stock certificates with bullet points in a frame below that, saying, here are the reasons we made these huge mistakes. Let's not do it again. So I think just realizing, and I'm thinking of another quote. Jeff Bezos asked the Airbnb founder, or Jeff Bezos, they were together with Warren Buffett. They said, your strategy is not that complicated. Why doesn't everybody just imitate you? And Buffett said, no one wants to get rich slowly. And I think just having a determination as a young person to get rich slowly. I mean, Buffett made 90% of his wealth after he was 60. If you have that mindset, if you really believe that you can build wealth slowly, and you're willing to do that, and you're willing to forego the speculations and the gambling and the double or nothing. I mean, play double or nothing long enough, you'll end up with nothing. And then where will you have the double, And so if I could possibly have gotten that into my 34-year-old head when I started investing, I would have been far, far more successful than I've been. I'm glad for the mistakes, because now I can talk about, to smart guys like you about it on podcasts. But I only know a few people who at a really young age get this into their head and do it well. And one of them's my business partner, Ben. He just came out of the gate at 20 years old. He's now in his 30s, but we started working together when he was 20. He had it in his head already. I want to get rich really, really slowly, and I want to avoid these extremes and these mistakes. And he's done amazing with that mindset.
I think that was really, really great, insightful answers. And, on my small office bookshelves, you got letters to the shareholders right there. And then, there's Benjamin Graham, who was Warren Buffett's mentor. So I think there's a lot of this unsexy ideology related to investing and making money that no one wants to hear. They want to hear how they can quadruple their money overnight investing in Dogecoin or, whatever it might be. But I think that it's still so hard for us to not make the same mistakes over and over and over again, because ego gets in the way. So whenever you're looking for operators to work with in your business, how do you determine this person aligns with your ideology to deploy your funds into their deal, or however it's structured? What is a green flag in terms of an operator you want to work with, and what's a red flag that you want to veer away from?
Well, we have a 27-point due diligence checklist, and it keeps growing every year. It's painful. We keep adding different things like NOI audits that cost like $10,000. Really deep background criminal reference checks. But we do simple things too. Like yesterday, we had lunch with a potential operator, and we walked out of there and just said, bad gut feeling. We can't put our finger on it, but just kind of a funny feeling. And you know what? Those feelings, I think God wired our brains and our whole selves with the ability to identify things that, there's like 2 or 3,000 nonverbal signals that our brain, our subconscious, our brain, our gut can pick up on that we can't identify like tangibly. I think those nonverbals are important. We look at their debt structure. We look at what they've done in the past with their worst deals, how they handled it. We look at, how they do their acquisitions. We look at their team. We look at what other people are saying about them online. We take a very deep dive on Google. We call it death by Google. And if these things don't check out, we have the courage, thanks again to my left brain partner and his team on the investment side, we have the courage to say no matter how good the upside looks.
Yeah, I think that's key, and it goes hand in hand with what we're talking about of risk mitigation and doing more to avoid losing than necessarily go after all the winners. And I think that's a characteristic of anyone that's successful in the long term.
Yeah, Warren Buffett said the best investors say no a lot. The very best investors say no almost all the time.
Yeah. A lot of it, it's funny, the whole conversation about thinking longer term and just mitigating against downside risk. I have two thoughts there. One being, I think humans in general are just so bad at understanding how compounding works. And so they often switch strategies or sell and trade to something else or end up losing their money before the compounding ever starts to take hold. And that's why so people, and myself included, often, unless I'm looking at a graph, a chart, don't understand compounding. And so they never get to the point where they really benefit from it. They go broke or they switch to something else. And so this is why I remember one of the first podcasts I ever heard, and this was right around when I read your book, Paul. I don't remember who it was, but the guy on it said he never sold a single one of his properties. And he was a multifamily guy. And a lot of the older people I knew that were the wealthiest, they all said the same thing about holding if you can, as much as you can. And so I've never sold any of the rentals I bought, and I'm going to stick with that. So anyways, everything you're saying was really resonating with me, Paul. And I wish I could get that through other people's heads more, but it's, like Mason said, hard to learn through someone else,
and it's hard to imagine not selling when people were, these syndicators in the 2015 to 2022 range were selling in a year and a half or two with, floating rate, no penalty debt, no early payoff penalty. And they were doubling investors' money and over and over. And it was like a game of musical chairs. And yet I met a guy on Twitter from New York, and somehow or another, he got introduced to Charlie Munger, and he got a chance to go sit in Charlie's office or living room for like 4 hours right before Charlie died. Of course, there was no sign Charlie was going to die. But the last thing Charlie said to him is, he said, "Son, you made a lot of mistakes. Every time you sold a property, it was a mistake."
Yeah, that's what I tell myself. So it's good to hear he thinks the same way. So how do you kind of bring to the present, to what's going on right now? Since I started reading about real estate in 2017, started buying in 2018. It was nothing but up, right, for quite a while. And everyone talked about how there's no deals. Oh, I wish it was 2011 again, people would say, so I could buy properties at pennies on the dollar. And now here we are, where a lot of markets are experiencing significant distress. Inventory has risen. Obviously, I'm generalizing, but people are afraid. And now it's, I want to wait. I don't know what's going to happen. I don't know where interest rates are going or what the geopolitical situation is going to do to the economy. So in your current acquisitions, how are you balancing the uncertainty with the opportunity that creates and still taking action and buying assets?
I mean, I don't want to overgeneralize, but Warren and Charlie said that in their 55, 60 years of investing together, they never had a single meaningful conversation about the economy. when they decided to invest or divest. And I could hardly believe that, but they basically said they were looking for durable products run by capable managers at prices that were well below the true value. You know, Buffett famously said, price is what you pay, value is what you get. And if you do that in any economy, you can sort of ignore the macro economy when making your decisions. We invest in things like mobile home parks and RV parks that have a huge percentage of mom and pop operators. And I could take the rest of the show to tell you story after story about mom and pop operators and how poorly. I mean, I heard one an hour ago from an operator we're about to invest $9.5 million with. He bought a mobile home park in Virginia, and the operator was so bad that they hadn't collected rents from some of the tenants for 15 years. And so when you can get deals like that, you know, it's quite amazing, you know, and like I think 94% of multifamily properties above 50 units are run by LLC, you know, professionals that have multiple properties. But something like 80 or 90% of mobile home parks and probably even higher percentage of RV parks are run by mom and pops. And that creates a potential for significant intrinsic value and therefore a lot of upside and protection from the downside in any economy.
Yeah, absolutely. And Paul, let's jump into the technical aspect of it. For this deal that you're talking about, looking at deploying $9.5 million, both on the acquisition side of the deal or the property, as well as the fundraising, take some time and walk us through how you've made this happen, if you're able to, on this one.
Yeah, I think I'd rather talk about our previous deal since it's closed.
Perfect.
So in January, actually, we started raising money in January for a multifamily deal in Odessa, Texas. This, oddly enough, and this is an exception for us, it was acquired from the very opposite of a mom and pop. It was an institutional operator who was closing down a fund a year ago. And this one property, for some reason, they hadn't gotten around to selling, and then it fell through last fall. The buyer fell through at the last minute. So they priced it, get this, $51 million for this property that was appraised at $65 million. It had assumable Fannie Mae debt, and the capital stack looked like this. It was $30 million in assumable Fannie Mae debt at, you know, a really nice interest rate. I can't remember what it was, but it seems like it was in the fours. Had $21 million in equity, and we brought 15 of the $21 million. And that, here's how it looked. The $6 million brought by the general partner and his friends and family and his group of LP investors, that $6 million was in first loss position. So if you can picture a capital stack with $30 million in debt on the bottom, $6 million in GP and LP equity at the top, we were in the middle with $15 million. And as far as payout, we were pari passu, meaning we were getting the same payout as all the LP and GP operators, the same, you know, type of waterfall. But at the time of sale, we were paid off. We will be completely paid off first before the GP and LP. What that means is if for some reason that $65 million appraised value drops to 51, which is what they paid for it, and then 6 million down from that, down to 45 million or so, our principal won't be touched. And that's the benefit of being, you know, the largest investor and being able to negotiate those kind of terms. It gives us extra safety, but it gives us the same or very similar upside to the other LP investors. Does that answer your question, Mason?
Yeah, it does. And I want you to expand a little bit on this. I think the term you coined is this JV hybrid equity that how do you go about approaching a GP with this structure? Because it's a little bit different than maybe a traditional capital stack.
Yeah. So the operator, this is for an operator who might already be tapped out on their own capital, or they might have $1 million to put in, but not 21. They have limited number of LPs. They don't really want to run a capital raising company. They don't want to run a fund management company. They don't have 3,000 investors on their list when they go do a deal they can email to. They only have a couple hundred, maybe less, friends and family who invest with them. And so for them, it's great to get one check from us. Of course, with that comes, the fact that we're in the middle of the capital stack. We get management control rights. We get forced sale rights. And this operator was so confident, as he should be, after looking closely at the deal, so confident that they were going to not lose money on it, that they were willing to give us those terms. I think, it's as far as approaching them, what we did is 3 years ago, 2.5 years ago, we came up with the idea of doing preferred equity. Now, JV hybrid equity, as I coined it here, deemed it here, that's a hybrid between preferred equity and common equity. So you've got debt at the bottom of the capital stack. Then you might have mezzanine debt, which would be like a second mortgage. Then there's preferred equity, which gets usually a fixed payout and a fixed compounding accrued upside. JV hybrid equity, I would say, is higher than that in the capital stack in the sense it's got a little more risk. It's not generally in the same stack, but it's got a little more risk, but up significantly higher upside. And then, of course, you got your common equity in the first risk position, first loss position. But approaching them 2.5 years ago, we said, hey, why don't we go out and just put the word out that we want to invest preferred equity. So I personally called, emailed, texted about 150 debt and equity brokers using the 80-20 rule again. We figured, maybe 30 would reply to us, and I think maybe 15 did actually, so 10% of them. And of those 15, like 5 had just sent us so many deals. And that's how we approach it.
Okay. So that's the money side of things. What does the operations or the value play look like in this deal? Or is it just kind of leaving it as is and holding because you're buying below appraised value?
Yeah, the value play in that particular deal is not really that interesting. They were going to make moderate improvements to the units, and they believe that the improvements will drive about $75 in rent growth. These are class, I would say, B- workforce housing in a market that's booming because of the Permian Basin oil and gas play that you guys are certainly familiar with. Of course, there's some risk with that, right? Because, the break-even price on producing oil is probably $50 to $60 a barrel. And if it goes way below that, it's probably going to affect, the housing in this area. But there's no new housing supply in the area. There's a significant increase in people coming to the area. A national study said that actually Midland, Texas, was going to have 18% rent growth in 2025, and Odessa was right behind it at like 14%. And believe it or not, between the time they went under contract and the time they closed, if I'm not mistaken, they had about 14% rent growth just in that period. So that was a straight, value that just accrued right to the buyer right then, right during that 3 or 3.5 month waiting period. So it was quite an uninteresting upside. They can increase occupancy a little bit. It's at 90 now. They'll be more focused than the other property managers. I think since it's, it's a big deal for them, was a tiny deal for the other group. If they can get occupancy up from 90 to 94, that would be a big win. And then there's just some other minor things they were going to do. A lot of other deals we've invested in have so much more interesting stories, though.
Well, let's talk about that. What's one you have done recently or are working on that it's a bit more interesting to talk about?
One of our operating partners bought a self-storage facility in Henderson, Nevada, right next to Las Vegas. The the operator was the same person who built it 42 years earlier in 1982, I think. And it had a whole bunch of homeless tenants in it, which is illegal, by the way, and unsanitary, as you can imagine. There's no running water there. They had homeless tenants. They were charging $60 per 10 by 10 unit, right on the right in the suburbs of Las Vegas. The going rate for a 10 by 10 for a well-run facility is 148. So the operator went in. They actually put a real sign out front. Amazing. They put it online. They actually put it on the internet. The internet's this new thing. No, I'm just kidding. And they put it on the internet. They started marketing it. They cleaned it up. They, of course, evicted the illegal homeless tenants. They raised the rates from 60 to maybe 100 with the goal of getting to the 148 market average in a year or so. And I mean, the formula for commercial real estate, it's the value is the net operating income divided by the cap rate. Keeping the cap rate the same, if you can double the net operating income, you double the value. And I don't think it's very hard to imagine how he could double the net operating income in this, especially when adding other things on top of the rentals, like, U-Haul that can add $2,000, $3,000, $4,000, $5,000 a month to the bottom line. Adding the sale of items like locks, boxes, tape, and scissors. Getting occupancy up from 80%, which is where I believe it was, up to 90. I mean, right there, that's a huge increase in income. So all these things make it, pretty hard to imagine how he'll lose money. Let's put it that way. That's our first goal at Wellings Capital, which is protection of principal.
Yeah. Yeah. Nevada's an interesting market with the airport, the new airport that they're working on down by Prim, and then the train coming from Riverside over. So it'll be interesting to see how it continues to grow in the coming decade or two.
Right.
Well, Paul, those sound like wins to me, but we talked about a wall of shame earlier. Yeah. If you were to look back in your career, and if you had the centerpiece #1 trophy on your wall of shame, tell us that horror story of that deal.
How long do you have? I mean,
we have, according to you, about 22 minutes for you to.
Okay. There's so many. I don't even know which one to pick. I mean, I could go outside of commercial real estate and just tell you many worse deals.
Maybe the overall worst monetary loss.
I think it was a multifamily deal. I told you we transitioned after years of trying to do multifamily. We just kept getting outbid. We weren't willing to overpay significantly, but we bought a 1962 asset. And our mentor, and in fact, my book, The Perfect Investment, I believe, said don't buy anything before like 1980. And we were so desperate to try to be a multifamily syndicator that I don't think we really significantly overpaid for this. It wasn't the issue. It was the fact that we were buying a 1962 asset. I think we kind of wondered why there wasn't a huge buyer pool circling for this. And we kind of stopped up our ears and ignored our mentor saying, don't buy something before 1980. You'll be sorry. Well, we got in there. It was 125 units. It was about $8.5 million acquisition in Lexington, Kentucky. My book had been out for a year and a half at that point, and so I had gotten on probably dozens and dozens of podcasts. I had my own show for a year by then. And so when we went out to raise $4 million, we were able to raise $4 million from 51 investors very quickly. And we got in there, and the property management was much harder than we thought it would be. There was new supply that we weren't expecting came in fact, messed up a whole lot of other Lexington operators. The one mistake we made was there was an operator nearby who was doing beautiful value adds. We walked through their apartments. They were raising their rents from $825, which is right where we were, up to $1,050. Well, the problem is we didn't wait along, or we couldn't wait to find this out. They weren't able to get the $1,050. In fact, they brought those back to like 900, and their units at 900 were way nicer than our units at 825. And so that was hard. And then to make it worse, within a year, we started having underground water leaks in these iron pipes from 1962. And the first building of 19 had a $107,000 repair. And so we went out to our investors after a year after that and said, there's no reason to believe these other 18 buildings won't have similar water leaks. And we've got all these other challenges. And we actually also believed that we were at the top of the market, that like cap rates had compressed as far as they would go. We were wrong, by the way. But we believe that like we just don't see how prices could go much higher. We have an offer. We said, would you rather sell right now and lose? It turned out to be 18% of your principal. That was so painful to look in these 51 investors' eyes and say this. Or would you rather hold out, hope that there's no more water leaks, and hope we can turn this around? And all but one investor that voted to sell. And so what I did is I actually went to the investors, and this was really hard. I think I started crying the first Zoom call I said this to an individual investor on. I said, I'm going to ask you to trust me again. We had started the funds by then. And I said, if you will reinvest your 82% of the proceeds that you get back from this, I will, in writing, guarantee you will make the 12% annual return over 10 years you originally signed up for. And that's starting at 82%. And we'd already lost 2 years by then. So it was going to be really hard to do that. But I was confident we could do it. I said, I'll guarantee in writing you'll 12% over 10 years, or I'll write you a check out of my pocket. And I said that to every single investor. And so a bunch of them signed up with us again, and then a whole bunch far more did not. They were, because they just walked away, and we've never heard from them again, even though we've reached out to them and said, hey, we're so sorry. So here we are, 7 years later. I'm still sick about it, but that's got to be the worst.
Yeah, that sounds painful, and there's no. I mean, losing investor capital is just, it's the worst. It's something we always try to avoid at all costs, because it's their hard-earned money. And sometimes, we have blinders on a little bit of, you're so used to being that entrepreneurial life cycle and roller coaster of make money, lose money, make money. But if, it's the W-2 person that works, their time is directly related to it, that can be really painful. So, right. Paul, when underwriting these deals, something that I'll see on, I'll say it for a specific deal, RV park out here, or mobile home park, I should say, they're trying to sell it on a cap rate that's based on a stabilized portfolio. They are, the last rent roll they gave me was over a year ago. And I asked the agent on there, I was like, okay, well, it's talking about stabilized portfolio and market rent rates. That was a year ago. Have they raised the rent rates? And they're like, no, haven't raised the rent rates. So how, during the underwriting process, are you negotiating and successfully making offers whenever you determine that there is that value add play, and you can see what the stabilized portfolio, like the Nevada self-storage deal, is? How do you negotiate potential additional discounts when you're making those offers?
Well, actually, we don't have to anymore, because as the fund manager, we're investing with operators who are doing that negotiating. And so, Mason, we actually don't have to do that. We never plan to be the operator again. The operators who we invest with are 100 times better than we could do it. And so we're just trusting them to do the heavy lifting, and that's one piece of it.
So all that due diligence is done more so when you're vetting the operator to know that they're making those negotiations and they're buying the good deal because you're investing in the person rather than the deal. Am I hearing that kind of right?
Yeah, we're investing in the person first, and we're spending a lot of time getting to know them and their team, and then secondarily, but very important also, we're looking at the deal, but we're not negotiating it ourselves.
Got it. So speaking of the operators, something that, as more just an observer, I haven't done any syndications or invested in syndications, but I know how it works. And something that's always bothered me that I've seen heavily debated is the fee structure, the compensation, where a lot of these people are making a lot of money as soon as the apartment closes, just based on the purchase price.
Yeah.
That's not a perfect alignment of incentives there between the syndicator and the investors. How do you feel about that? How much does how they have their fee structure set up play into your decision to invest with them? Just general thoughts.
If the first thing I'll say is we don't feel great about that. We think that is a huge misalignment of incentives, like you said. And so we generally do not work with operators who do that. However, when we do make an investment, because we're using this JV hybrid or preferred equity structure, we're not coming in under that waterfall anyway. We're not coming in under that fee structure. So we can negotiate a completely independent fee structure. So if we thought that they were a little high on the acquisition fee, maybe we would ask to share that, for example. And by the way, if we did share, we would give all of ours to the investor. We would not keep any, because eventually that's going to come back and benefit us in the end anyway. But no, we generally think that that's a big no-no. That's one of our big things we look down upon, frown upon when we're looking at an operator right up front.
Sure. Yeah. I mean, it encourages investors to go bigger and bigger because then they can, of course, get a bigger fee. And I remember, especially during the boom, 2020, 2021, there was so many gurus and investors talking about, go big on your first deal. Anything smaller than 100 units is too small. And I think that's ridiculous for someone that's not experienced, but that fee structure certainly incentivizes it.
Yeah, right. It sure does.
Interesting. Okay. All right. So we've talked a bit about what you're working on today, parts of the country. What do you see as the biggest opportunity going into the second half of 2025 and into 2026 across any of the commercial real estate assets you're investing in?
Well, I give the same answer almost year in and year out, and that would be I really think manufactured housing, mobile home parks, manufactured home communities, whatever you want to call it, is a huge opportunity because it's the only asset type we know of that has a decreasing supply and an increasing demand every year. It's amazing to me. I went to we do in-person due diligence on these assets that we invest in. And this particular one was in Alaska, and we were going to look at it, and the competitors had actually gone out of business. Like 2 of the 4 competitors were shutting down because of broken sewage systems and different issues that they had. I mean, like when you're a mobile home park, with like 50 lots and your whole sewage system goes down, and you have to, now that there's brand new standards since it was built in the 60s, and now you have to, spend $2 million. I made up that number, but let's say it's $500,000 or $1 million to fix it. And you're already down to 60% occupancy and blah, blah, blah. A lot of them just shut down. Another reason they shut down is the city comes in and says, let's say it's a developer. He happens to own a mobile home park and he's building multifamily across town. And the city planning and zoning people will literally cut a deal with them and say, look, we'll give you a permit on this new multifamily, but we want you to shut down that eyesore over there. There's this thing called NIMBYism, which is not in my backyard. Not my backyardism. All these politicians say that they want to increase affordable housing, but they don't really want to a lot because, there's hardly any property tax paid, yet there's a huge drain on services, bus systems, school, education, etc., from the mobile home parks. Another issue is, there really is an affordable housing crisis. 10,000 people will turn 65 today, but 6,000 of them will not have $10,000 in cash saved for retirement, which is amazing. And a lot of those people, though, do have home equity in their home, and they'll trade that in to buy a mobile home and go to a mobile home park for, say, $500 a month lot rent and be able to live. They'll have 2 parking spaces, their own deck, their own yard. They won't have to share a wall, go back to an apartment, and they can be free to live a flexible lifestyle. One of my friends' dad was a really distinguished doctor in Southern California who actually chose to go to a mobile home park to live out his last decades of life after he retired because he wanted to. He wanted the flexibility that gave him and not having a home, or he didn't want an apartment. So there's a lot of reasons mobile home parks are a great investment. And I mentioned earlier, one of the big ones is they're usually mom and pop operated. The deal we're working on right now, which I briefly referenced, we've raised $5.5 million in like 5 days for this. And that is 5 mobile home parks south of Raleigh, North Carolina. And there's just so many reasons to believe that this deal is going to go well.
Yeah, I have seen this myself. I can't tell you how many lots have sold where the person buying it was just looking to park their mobile home there. And that's the first question we almost always get in a lot of parts of the country when doing business is this zoned for mobile homes? Is this zoned for mobile homes? It's so much more affordable, and I think affordability is driving most of the market. And so if you can offer housing that's affordable, I think you'll still continue to do very well in the coming years.
Yeah.
And one more quick question about mobile home parks that you guys are looking at, Paul. And maybe it's more on the operator side, but do you have a preference of park-owned mobile homes versus people that are parking their own mobile homes on it and just paying lot rent, or does it matter to you?
It matters a lot. That's one of the biggest opportunities. So I told you I wasn't going to talk much about the current deal, but I have to say this. So this one has 232 lots. 108 are tenant-owned homes. 20 are rent-to-own. And I don't know if I'm going to do the math live on the show right, but I think 107 are park-owned. Now, park-owned homes, you mean the park has to do the maintenance. They have to go in and fix the plumbing. They don't get the pride of ownership, so the owner might just, be more willing, some drunk guy might be willing to, punch a hole in the wall, and all kinds of reasons that park-owned homes are bad. In fact, so much so that Fannie Mae, Freddie Mac, they have a minimum standard. They want to see 75% or higher tenant-owned homes before they'll finance a park. And so this park with, just rough math here, 55% tenant-owned homes, it couldn't get Fannie Mae, Freddie Mac financing, which is a big benefit to the buyer because now they were able to ask the seller and say, hey, first, it limited the buyer pool tremendously. And the seller's now saying, the buyer's saying, hey, please owner finance this. And so the seller's giving seller financing at 4.5% for interest only the first 5 years. And the buyer's plan is to convert, I think it's like 35 of these park-owned 2-tenant homes over the first 3 years. So 35 a year for 3 years will get up to basically 100% tenant-owned homes. They'll be able to refinance it with Freddie or Fannie. They'll have a lower cap rate. They'll be able to sell to an institutional buyer. So many benefits of starting with park-owned and converting them to tenant-owned homes.
Yeah, absolutely. And yeah, I agree with that strategy, and you're able to sell all those homes to the tenants on potentially owner financing, which might increase the cash flow right off the bat. But Paul, we want to be respectful of your time. One question we like to ask all the guests before we sign off is, what question did we not ask you that we should have asked you?
Yeah, I think if you had to go back and ask, or you can ask me this, if you were asking me as a 25-year-old what I would do differently, like what could I shift? And we touched on this a lot early on. What would it be? And that would be this horrible tendency I had to chase shiny objects, to invest in things I knew nothing about. I could tell you stories about, just jumping. My basic default was to say yes to everything unless it proved egregiously bad. Instead, as we've talked about on the show, our default needs to be to say no. Warren Buffett talks about no strike. Investing is a no strike called game. You can stand there for 1,000 pitches with your bat on your shoulder and you wouldn't get a walk or a strikeout. And of course there's opportunity cost that's lost, but just learning to say no. It was basically the problem with me is I was trying to get the same thrill, the same excitement out of my investments that I got out of being an entrepreneur. And I call that entrepreneurial investing. And that was just the biggest mistake I probably ever made. And it cost me a literal small fortune. And I had to start over in my mid-40s after just pretty much squandering the money I made in my 30s selling my company.
Wow. No, and that's great advice. And I think that what people need to realize is that even if you're the entrepreneur, it's okay to have really safe investments and be able to kind of distinguish those two. But Paul, where can people find out more about you?
Yeah, they can go to our website. It's called Wellings Capital, WELLINGS, wellingscapital.com. And if they want to get a free guide on investing in mobile home parks or self-storage, other stuff, they can go to wellingscapital.com/resources.
Paul, thank you so much for your time today. We truly enjoyed having you on the show. This was great. And everybody, this is Paul Moore with Mason McDonald, Dan Haberkost, signing off.
Thanks, Mason. Thanks, Dan.